Welcome to Talk Tickers. Today we are breaking down the Q4 2025 earnings call for Heritage Financial, ticker HFWA. And look, on the surface, the results were a clear win. But the stock's reaction, well, that tells a much more complex story, and that's the puzzle we're going to solve today. So let's dive right in with the headline number. Heritage posted a GAAP EPS of 65 cents. That is a solid 9-cent beat over what analysts were expecting. And, in the world of regional banking, a beat of this size is a pretty big deal. It's the kind of thing that gets investors to sit up and pay attention. Okay, and this is where it gets really interesting. The market had this kind of split personality. On the back of that strong beat, the stock rocketed up almost 7% in pre-market trading. But then, during the actual conference call, the reaction went totally flat. So that sets up the big question for our explainer today, right? If the numbers were so good, what on earth was said during that call that slammed the brakes on the stock? We're going to break down their impressive margin performance, dig into the massive acquisition that's reshaping the whole company, and then, we'll give you our final take. The answer to that strong earnings beat? Well, it really starts in the engine room of any bank. It's net interest margin, or NIM. And this quarter, let me tell you, that engine was absolutely firing on all cylinders. And management, they made this crystal clear. The CEO, Brian McDonald, kicked off the call by pointing right to this metric. He basically said, look, our improving NIM was the #1 reason earnings were so strong. No ambiguity there at all. So how'd they pull it off? It's actually pretty simple. As market interest rates started to fall, Heritage was able to pay out less on its customer deposits. And that means the gap, the spread between what they earn on their loans and what they have to pay for their deposits got wider. That directly boosted their net interest margin by a healthy 8 basis points. And you can see how this strategy paid off right here. I mean, look at the clear quarter-over-quarter improvement across the board. NIM is up, return on average assets is up, and net income saw a really significant jump. The model is absolutely working. But here's the thing. This quarter's story isn't just about good internal performance. The real reason for that hesitant stock reaction, it has everything to do with a massive strategic shift that is right around the corner. See, the impending acquisition of Olympic Bancorp is the real story here. It's the biggest risk, for sure, but it's also the biggest potential reward for the stock. This is what all the investors on that call were really focused on. Management gave a very clear timeline for this. The deal is set to close this month, January 2026. But the really heavy lifting, we're talking the full system conversion and integration. That's not going to happen until September. And that means the full benefits, the real synergies, won't be seen until 2027. So there's a bit of a waiting game here. And if you follow regional banks, this move is going to look pretty familiar. It's a classic playbook. They're expanding their footprint in the super important Puget Sound market, they're creating opportunities to cut overlapping costs, and crucially, they're getting their hands on Olympic's valuable low-cost deposit base. That's the fuel for future growth. It's a textbook move to build scale. So this brings us to the forward-looking picture. And really, the billion-dollar question that investors are asking now is, can management actually deliver on the promise of this massive merger? Management's guidance was definitely on the sunny side. They're telling investors they see loan growth getting back to normal, they're targeting a net interest margin that's approaching 4% by the end of the year, and they held firm on their expense guidance. It's all about discipline. But all that optimism gets balanced against this one crucial term, execution risk. And folks, this is the very real challenge of smashing two different banks together, two systems, two cultures, without blowing up operations or failing to get those promised savings. This right here, this is the risk that cooled off that pre-market rally. Okay, so let's put it all together. You've got a fantastic standalone quarter on one hand, and this huge looming merger risk on the other. Where do we land on this thing? What's our official call on the stock? All right, let's get down to brass tacks. What does this all mean for next quarter? Q1 2026 is going to be the first report that includes the Olympic acquisition, and here's what our model is forecasting. Look, we believe the positive momentum from their core business, combined with just tacking on Olympic's balance sheet, is going to lead to a slight beat versus what the street is expecting. We see EPS coming in around 70 cents on slightly higher than expected revenue and NIM. Now, as for the stock price, don't expect fireworks right away. We think it's going to trade sideways for a little while, as the market just waits and watches for proof of a smooth integration. But as the company starts hitting its milestones, especially that key system conversion in September, we expect the stock will start to grind higher toward those new $32 price targets. So, our final verdict here at Talk Tickers is an outperform rating. We believe the long term strategic and financial benefits of buying Olympic, we're talking about the scale, the low cost deposits, we think those benefits outweigh the very real, but we think manageable near term execution risk. This is not financial advice.